Today, we're going to discuss a topic that affects many of us: money traps that the middle class often falls into. It's essential to be aware of these traps so that we can make informed financial decisions and secure our financial future. But before we dive into this topic, don't forget to hit that subscribe button and ring the notification bell so you won't miss any of our valuable content. Let's get started. Number 1. Lifestyle inflation. Lifestyle inflation, also known as lifestyle creep, is a subtle yet significant money trap that many middle-class individuals find themselves ensnared in as they progress in their careers. When you get a raise or a higher-paying job, it's natural to want to enjoy the fruits of your labor, but it's crucial to do so responsibly. As your income increases, so do your expenses. You may find yourself trading in your reliable old car for a brand new, more expensive model, or moving to a larger, more luxurious house. You dine out at fancy restaurants more often and indulge in lavish vacations. While these changes can make life more enjoyable, they can also lead to financial strain and anxiety. Living paycheck to paycheck, constantly trying to keep up with an inflated lifestyle, can be stressful and unsustainable in the long run. To avoid this trap, consider setting a budget that allows for some indulgences while prioritizing savings and investments. Remember that financial security and peace of mind are invaluable, and they are achieved by making prudent choices as your income grows. Number 2. Credit card debt. Credit cards are undoubtedly a useful financial tool, offering convenience, security, and rewards when used wisely. Unfortunately, they can also be one of the most treacherous money traps when mismanaged. The allure of credit cards lies in their convenience and the illusion of having extra spending power. It's easy to think of credit limits as additional income, but this mindset can lead to a perilous cycle of high-interest debt. Carrying balances from month to month and making only minimum payments can result in exorbitant interest charges that slowly erode your financial stability. So, how can you avoid falling into the credit card debt trap? The key is responsible credit card usage. First, develop a budget and live within your means, ensuring that your expenses don't exceed your income. Use your credit card as a payment tool, not as a source of financing. Always pay your balance in full each month to avoid interest charges. If you find yourself already mired in credit card debt, it's crucial to have a clear debt repayment plan. We have explored debt management strategies and tips to regain control of your finances in our previous videos. Remember, when used prudently, credit cards can be a financial asset, but they can quickly become a liability if mishandled. Number 3. Neglecting emergency savings. Neglecting to build and maintain an emergency savings fund is one of the most significant financial pitfalls middle-class individuals can face. Life's uncertainties can strike at any moment, whether it's a medical emergency, a sudden job loss, or unexpected home repairs. Without a cushion to fall back on, you may find yourself grappling with financial stress and mounting debt. To avoid this trap, it's crucial to create and sustain an emergency fund. An emergency fund acts as a financial safety net, providing you with peace of mind and the ability to navigate unexpected expenses without derailing your long-term financial goals. Financial experts typically recommend saving at least 3 to 6 months' worth of living expenses in your emergency fund. However, the ideal amount can vary based on your personal circumstances and financial goals. The important thing is to start building your fund as soon as possible. Start by setting a specific savings goal each month and automate contributions to your emergency fund. Over time, you'll accumulate a substantial safety net that can help you weather life's storms without falling into debt. Number 4. Overspending on education. Higher education is undoubtedly a valuable investment in your future, opening doors to better career opportunities and personal growth. However, one of the significant money traps that many middle-class individuals fall into is overspending on education, primarily due to excessive student loan debt. In today's competitive job market, there's often a strong desire to pursue prestigious schools and degrees, but when you graduate with a mountain of debt, the financial burden can be overwhelming, especially if your post-graduation income doesn't match your expectations. To avoid this trap, it's essential to approach higher education with a well-thought-out financial plan. Start by researching affordable educational options, including community colleges, online courses, or state universities that offer quality education at a lower cost. Scholarships, grants, and part-time work can help alleviate some of the financial strain. Another strategy to consider is to attend a community college for your general education requirements before transferring to a 4-year institution. This can significantly reduce the overall cost of your degree. Ultimately, remember that the name of the institution on your diploma is only one factor in your career success. Your skills, work ethic, and experience are equally important. By being financially savvy in your educational pursuits, you can attain a quality education without jeopardizing your financial future. Number 5. Neglecting insurance. Insurance might not be the most riveting topic, but it's a financial safeguard that should not be underestimated. Neglecting insurance can lead to substantial financial setbacks, especially when life's unexpected challenges arise. There are various types of insurance, each designed to protect different aspects of your financial well-being. Let's take a closer look at some of the most critical ones. Health insurance. Medical emergencies can be financially catastrophic without proper health coverage. It safeguards you against exorbitant medical bills and ensures you can access necessary health care. Auto insurance. If you own a vehicle, auto insurance is mandatory in most places. It protects you from the financial consequences of accidents, vehicle theft, or damage. Homeowners/renters insurance. Protecting your home and personal belongings against unforeseen events like fires, theft, or natural disasters is crucial. It provides peace of mind and financial security. Life insurance. While not directly benefiting you, life insurance provides financial protection for your loved ones in the event of your passing. It's especially important if you have dependents who rely on your income. Disability insurance. This often overlooked insurance type provides income replacement if you're unable to work due to a disability. Neglecting any of these insurance types can lead to devastating financial consequences. Even seemingly small insurance premiums can save you from immense financial burden in case of unforeseen events. Number 6. Cosigning loans. Cosigning a loan for a friend or family member is a well-intentioned gesture, often driven by the desire to help a loved one during their financial struggles. However, this seemingly kind act can quickly become a significant money trap if not approached with caution and awareness. When you co-sign a loan, you're essentially vouching for the borrower's ability to repay the debt. This means that if the borrower defaults, you become legally responsible for the loan, including both the principal and any accrued interest. While your intentions are noble, this can lead to dire financial consequences. One of the most significant risks of co-signing a loan is the potential damage to your credit score if the borrower misses payments or defaults. This could affect your ability to secure credit or loans in the future. Moreover, it can strain your relationship with the borrower if financial difficulties arise. Before co-signing a loan, it's essential to thoroughly assess the borrower's financial responsibility and your own capacity to handle the debt if they can't. If you still want to help, consider alternative options, such as providing financial advice, suggesting budgeting strategies, or assisting them in finding other resources. Number 7. Neglecting financial education. When it comes to financial traps, perhaps the most insidious one is the neglect of financial education. It's a trap that can affect anyone, regardless of income or age. Ignoring the need for financial literacy can lead to a lifetime of missed opportunities and financial hardship. Financial literacy is the foundation of sound money management. It empowers you to make informed decisions about your finances, plan for the future, and navigate the complex world of investments, taxes, and debt. Without this knowledge, you're vulnerable to making costly mistakes and falling into the other traps we've discussed. So, why is financial education so crucial? It helps you understand how to create a budget, save for emergencies, invest wisely, and plan for retirement. It allows you to identify scams and make confident decisions about loans, mortgages, and credit cards. To avoid this trap, it's essential to invest time and effort in improving your financial literacy. Read books, take online courses, attend workshops, and follow reputable financial websites and channels. Make use of financial planning tools and seek advice from financial professionals when needed. Stay tuned to this channel to become a more financially savvy individual and avoid falling into the trap of neglecting financial education.